Ashwini Kumar Hooda, Deputy Managing Director with India Bull Housing Finance now joins us. Ashwini, good morning and thank you for joining us. Now the Q3 AUM growth was about 32%. What is the overall loan book growth and where do you see that could stabilize for next 2 to 3 years?
So from a long-term perspective, we have guided the market that we will grow between 25 and 30%. We've been able to grow faster than 30% for last 2 years, backed on very good structural volume in entry-level houses being sold. So affordable housing has been compounding at more like 33% in FY17, and we believe this financial year it would be closer to 35%. So from that perspective, we've been able to grow at 30% plus. Our own sense is that growth should accelerate from here, which will allow us to compound at 30% plus or thereabout. But we definitely believe that market has enough momentum that we can grow in excess of 25%.
Now, home loan books or the home loan accounts for 60% of the total book. How has been the mix between home loans and the LAP book, and how could it shape up going forward?
So Indiabulls Housing has been getting rating upgrades from both international rating agency S&P and Moody's local ratings, as well as from domestic rating agencies over a period of time. The additional benefit on our bond yields decrease, we've tried to pass it on by increasing the composition of home loan in our book. As we speak, we are 60% home loan, 20% LAP and 20% construction finance. The same number 2 years back used to be 50% home loan and 25% each of LAP and corporate loans. We believe that the optimum mix for the company is 66% home loan, 17% loan against property and 17% corporate mortgages, which we have guided the market that we should be able to achieve by FY20. So March 20 we should be at our optimal, where 2/3 of our book is in form of home loans.
Right. Also then, banks have started hiking MCLR already. What percentage of your borrowings come from banks, and hence by how much do you see your cost of funds increase thereby?
So banks contribute less and less of our incremental cost of funds. So to give you perspective, in the first 9 months, almost 82% of our funding has come from the bond market, around 11% of funding has come through securitization, and hardly 5 to 7% has come through the banks. So we are relying less and less on the banks, and primarily we are borrowed from the bond market, which is over a very long term always cheaper than the intermediate structure like a bank market.
Okay. There are many concerns over margins coming under pressure for you. Where do you see your margins close in for FY19, and will you be passing over a higher borrowing cost to customers, thereby charging a higher yield?
We as a lending institute is purely pass through. So whatever are the benefits or the cost increase that we experience, we are a pass through and we pass it on to our customers. In case the higher yields that we have seen in the recent past sustain going forward in next financial year, then a part of that will be passed on to the customer. I don't expect it to be a huge number, but we've already seen other banks increase it between 15 and 25 basis point, and we would also be increasing in that ballpark number.
How do you see property prices shaping up in key markets, and what kind of impact do you think that could have on your entire portfolio?
So again, real estate is many markets. If we are talking about entry level, where home prices up to 40-50 lakh rupees, that segment continues to do well, and it has been doing well over last 3-4 years, while overall real estate scenario has been weak. Most of the weakness is stemming from the premium end of the housing, where there is oversupply and demand also has been sluggish, partly due to the oversupply and partly due to the recent events around demonetization, GST and introduction of RERA. So, all these events had put a lot of pressure on high end apartment consumption. Mid market also has been slow, but in the recent past we have seen it grow, and as a result we believe that the mid housing would show good result over next financial year FY19, whereas premium end of the housing may start doing well some in more like 18 months from where.
Sold 10% stake in Oak North Bank to GIC. What is the rationale for this?
So, the stake sale to GIC in Oak North was driven by the fact that entire capital that we have in the business, in housing business, is for the housing opportunity. The opportunity is so large that we did not want to diversify or divert any of our capital. We had invested 2 years back $100 million in Oak North Bank for a 40% stake. We have sold 1/3 of our stake in the bank and recouped entire investment. So, we sold at 120 million. So, there is still a balance 20% stake in the Oak North Bank, which is a more of a strategic investment, and may if at all be exited, will be exited at much later stage. As of now, the rationale for 10% stake sale was simple: to recoup all our investment that we had done.
So, what is the scope to further improve return ratios, and what according to you would be the key drivers?
So, Indiabulls Housing is one of the most profitable and highest ROE producer in the market. Our ROE for this year is 28% plus. At the balance sheet size of around 1.3 lakh crore and profitability of around in excess of 3,600 crore, we continue to improve upon return on equity by around 1 to 2% every year, and that is being driven partly by the growth in the home loan business, where this year, for example, first 9 months we have grown at almost 38%.
What about the branch expansion plans then, and also if you have any inorganic growth plans lined up going forward?
So, we have grown organic in the past, while an inorganic opportunity is welcome, but we do not see any opportunity of size which can help us achieve 2 to 3 years growth. For example, coming financial year we will grow by something like 40,000-45,000 crore, and we do not see many opportunities to give us 2 years growth of 80,000-90,000 crore. From a branch network perspective, we have been going into tier 3, tier 4 cities, where we have opened these 80 new smart city offices. We call them smart offices because they are purely technology based. Either it is our internet based end to end digital e-home loan solution, or digitization of customer record, and we send those for central processing. So, these are very low cost branches that have gone into smaller cities where the business size may be low, but because of the low cost to income ratio, we are able to service those locations. Otherwise, we would have gone to these cities only 3-4 years later.
All right, Ashwini, appreciate your time and glad you could join us. Meanwhile, if I look at markets, there is nothing which really could be called out as a standout gainer across the clans. Across market cap, if I cut across, MMTC illiquid, but there is a buzz about STC and MMTC take merger, which almost is true now. Kadala is the one sizable name which you could point out and say, okay, yeah, this one is looking higher and this one is moving strong. Indiabull Real Estate, that mega deal, but I guess markets knew that this kind of a large deal was coming. Media has been reporting about it. V8 had also done that story. So I guess there was nothing large in terms of, there was nothing new in terms of what it meant for the stock, because it's a liquid stock and a lot of traders actually bought the stock in anticipation of this deal. So it's turning out to be a case of buy on rumors and sell on news for this one.